Welcome to Illuminati Silver. We tell you the truth about silver. Today is Monday the 7th of December 2020, and we're looking at an interesting article about black gold turning green, i.e. oil, and how it is attempting to go green and what implications this may have for our economy, investment, and eventually gold and silver prices. So let's take a look. For the past few months, we've pointed out that OPEC, and OPEC Plus because it now includes Russia, had been making a determined effort to keep oil prices not only above $40 a barrel, but to try and secure them close to and hopefully at $50 a barrel. We've seen this play out in that each of the past 4 weeks, oil prices have risen week on week. And OPEC Plus and others met last week and agreed to increase production but by a much smaller amount than markets were expecting, thereby supporting current prices and hopefully for them enabling prices to rise as the US dollar weakens. Now, many of us who have followed gold and silver for a number of years will be aware that historically one of the key determinants of mining profitability is the cost of energy, i.e. oil. And this often determined not only whether a mine was economic or not, but also to some extent restricted R&D, especially when precious metal prices were low, while oil particularly flirted with $100 plus a barrel. We have also raised the issue for the past year or so, or during the past year or so, that there is a general move not only towards green energy, but also towards a greening of the investment community, looking for green projects in which to invest. Now, in comparable terms, this sector is still relatively small. But rest assured, with the world's politicians on a green climate change agenda and businesses being rewarded for following suit, this trend is only going to increase. It was even announced in the United Kingdom that no new diesel or petrol cars will be made from 2030 onwards. In other words, only electric cars will be manufactured. So please be under no illusion of the trend. And also with what looks like is going to be a Biden presidency in 2021, this agenda will have additional momentum, which had, to some extent, been held back by the Trump presidency. So let's take a look at an interesting article published by the BBC late last week and written just prior to the OPEC Plus arrangement made on Thursday. It is admittedly UK-centric, in fact it's Scottish-centric, so it's the northern part of the UK, but the principles apply throughout the world. Now the article is 10 minutes long, but we hopefully make some very relevant commentary after it. So if looking at that article for 10 minutes is too long for you, either please speed it up or jump to perhaps the last 2 or 3 minutes of this podcast to hear our remarks. So let's go ahead and take a look at this BBC article. BBC article entitled The Greening of Black Gold by Douglas Fraser. Oil exporters are eager to stabilise or push up its price against the slump in demand from the pandemic and growing pressure for more efficient or lower energy use. Beyond the short term, the industry isn't just dealing with the familiar boom and bust cycle, but growing pressure for a permanent shift to far lower carbon emissions. It's eager to shape that future and remain part of it. In the United Kingdom, the move to hydrogen power, along with carbon capture, offer an opportunity to the industry to redirect its engineering expertise. Government has to provide the skills and training base, but how much more does it have to do to shape industries when Bifab, Scotland's best hope for steel fabrication for offshore wind power, cannot win any contracts and has now gone into administration? This isn't just any business cycle for the oil industry. As its major exporters in OPEC plus Russia convene this week to decide how best to sustain the price above $40, It's not just COVID-19 that's caused the tectonic plates to shift underneath them, and nor will vaccines make the challenge go away. Climate change and the political and consumer pressure resulting from it is forcing much of the industry to think hard about its future and to act. ExxonMobil this week joined other fossil fuel majors, including Shell, BP and Chevron, in writing down the value of reserves on a colossal scale, around $80 billion between them. The American-based ones are much slower to commit future investment funds to renewable energy, but BP and Shell are eager to redefine themselves. Engineering firm BiFAB goes into administration. That revaluing follows a sharp and chaotic drop in the oil price last spring, when OPEC plus Russia failed to agree a production cut in line with the global demand slump due to the pandemic and lockdown. They later agreed a cut of around 8%. Most have observed their self-denying commitments, and the cut has worked for them. The price of a barrel of Brent crude has recovered since spring and stabilized. With optimism about vaccines and more demand out of China, it now sits close to $50. But that's more than 25% down this year, and the dollar has been weakening. Gas has also been priced low, with demand from fuel-burning industries slowing up. Supply has been boosted by new pipelines and shipments of liquefied hydrocarbons. America's fracking industry can ramp up production quickly, but it's boom and bust in the Texas and Dakota scrublands. When the price drops, it's also the producing basin where companies fail. Exxon's $17 billion to $20 billion write-down reflects a wildly optimistic gamble 10 years ago. Keep it in the ground. That's nothing new to oil, with its breezy confidence that bust surely turns back to boom. Black gold always finds a way back because it's been inextricably linked with economic growth and prosperity. Until now. It is now being shunned by some institutional investors, and banks tread warily in dealing with it. Even in Norway, awash with wealth from oil and gas, its gigantic trust fund is no longer backing other countries and foreign companies to keep it pumping. Environment policy is heading in the same direction, with pressure to reduce subsidies and tax breaks. The Institute for Public Policy Research, a London-based left-leaning think tank, has published a report today urging UK and Scottish governments to keep oil and gas in the ground. It wants to see a reversal of the policy of maximum economic recovery and chief executives rewarded on the basis of their environmental performance. This comes with a social message to soften the economic blow. While it notes that many of the jobs are outside Scotland, 10% of Aberdeen jobs are reckoned to be directly oil dependent and 5% in Aberdeenshire. So IPPR offers a plan to avoid managed decline, instead making this a managed transition, somehow achieved with the consent of workers and communities. As a slogan, managed transition rather than decline chimes with industry efforts, as governments in the UK are signing up to ever more ambitious targets for achieving net zero on climate-changing emissions. The oil and gas sector is trying to respond with its own plans. Oil and Gas UK, which represents it, this week produced its annual economic impact report. In the past, it's been an impressive listing of jobs, investment, production by the millions of barrels per day and economic impact to benefit us all. This year, it reads more like a plea for understanding, patience and help with the transition to lower carbon energy. It wants to slash its own burning of carbons in the process of producing lots more of them, reaching net zero by 2050. That's made easier by quite a lot of decline expected by then, and also if it can deploy offshore floating wind turbines to power its production platforms. It argues that even the toughest targets for reducing carbon emissions would still require some oil and lots of gas to supply 46% of global energy needs 20 years from now. Hydrogen power. If there's to be a big transition to hydrogen, though not yet commercially viable, but in demonstration phase on buses and trains, some will be split from water molecules by wind power. But once wind has replaced nuclear power and met the demands of battery-driven transport, there will still be a need for gas to create blue hydrogen rather than the green, wind-driven variety, converting water to hydrogen at plants along the North Sea coast. Allied to that, the gas grid network is trialling the use of the current pipe network to carry hydrogen in a trial project in East Fife. Hydrogen can be 10% of the mix with North Sea gas, and without any changes to pipework or boilers. That mix alone can cut emissions significantly. Meanwhile, in a separate desktop exercise, the east of Scotland is being scoped out for such conversion. That depends on capturing gases' carbon emissions and storing them under the seabed, an expensive and complex technology that has had a number of false dawns and inconsistent UK government policy. Oil and Gas UK reckons that more than £2 billion has to be spent to get the industry going into the next decade, and that's just for transport and infrastructure. By 2050, it thinks there will be a need to capture and store annually the equivalent of half the carbon dioxide created by Britain's domestic heating boilers in 2019. That's going to take engineering know-how, and a knowledge of rock structures under the North Sea will surely help. So the industry is trying to persuade policymakers and the public that it is key to making this happen. The Acorn project, centred on the St Fergus gas terminal in Aberdeenshire, is the lead prospect for showing how. It was begun 2 years ago, is scheduled for final investment gateway in a year, and to be in operation in 2023. Having set out its stall on this last year, Oil and Gas UK is seeking also to lead and educate its own members, exploration drillers, producers, oilfield services, and the long and varied supply chain, into recognition that they have to make radical changes if they haven't already begun. The sector body is currently negotiating one of those deals, which have come to characterise Whitehall policy as a series of transactions. Industry ambition for the North Sea transition deal is very large. Oil and Gas UK estimates that the investment needed to achieve government targets on the energy transition are roughly 2% of total national output, or gross domestic product. That comes to around £50 billion a year sustained for the next 30 years. IPPR points out that such investment should come with a lot of jobs, 1.6 million across the UK, including 134,000 in Scotland, and that it is government's task to ensure training and skills are up to the task. BIFAB or bust. The scale of government intervention in the private sector economy is a hot topic in EU-UK post-Brexit talk and in Downing Street, where the departed Dominic Cummings appeared to have persuaded the Prime Minister to back far more intervention than usual for Conservatives. And in Holyrood, that's a question left hanging by the absence of any clear policy and the symbolic great hope for manufacturing tied to offshore renewable power. BIFAB, which has now gone into administration, has been denied the financial guarantee the Scottish Government promised and then withdrew. So its 3 fabrication yards remain mothballed, and scores of jackets for seabed installation are being built in China, Indonesia and the United Arab Emirates. Economy Secretary Fiona Hyslop says she is barred from offering subsidy of the sort that a commercial firm would or could not offer, and the Scottish Government's partner in keeping BIFAB afloat, Canadian engineering firm DF Barnes, is being blamed by her for a lack of investment. It seems odd, at least, that there is a need to be bound by European state aid rules less than a month from full economic Brexit, and it lost the SNP 2 votes at Holyrood on Wednesday. But leave that aside for now, because there's a more fundamental question. Why Scottish yards are not internationally competitive in the first place, and what is being done about that. Now, whilst this article is either peculiar to or focuses more on Scotland, its ramifications stretch across the globe, and with particular emphasis for those governments determined to adopt, embrace and develop the climate change green agenda. What we can say for sure, based on previous experience, is that costs associated with such projects will always be considerably higher than those estimated, and new jobs created considerably lower than those predicted. Now that said, we have to accept, because we have little influence over it in reality, that the direction we're all moving towards is zero net carbons, and what is uncertain for now is its impact on the precious mining community. Initially, we suspect it will mean higher costs, which could seriously affect mining supply, especially in the short to medium term. This bodes well for those of us wanting higher precious metal prices. It will also lead perhaps to a greater demand for those precious metals which are being used to both conserve energy and those used to reduce carbon emissions. And this is something we should not ignore, because rest assured investment analysts won't be ignoring that fact. We're entering interesting times, and please bear in mind that this greening of our energy supplies will have an effect on precious metal prices eventually. What we have to determine is whether that effect will be positive or negative. We suspect positive, certainly while this transition is carried out, as it potentially becomes more expensive to mine what reserves have already been identified, and may put off further exploration until greater certainty occurs, or that precious metal prices rise before more monies are invested in further research and development projects. Now, we hope you found that useful, and just a quick shout out to two videos we put out over the weekend. On Saturday, our regular Gold and Silver Weekly Update, and yesterday, the first episode in our series, Bitcoin versus Gold and Silver. And we've provided links to both of these in the description box below. Meanwhile, thank you so much for listening. If you haven't already done so, please subscribe to our channel, not forgetting to press the bell sign so you're notified of our videos as and when they are published. And late last night, we also published a discussion with controversially Greg on the Richard and Greg channel about the final weeks of Brexit. And again, we've placed a link to that below. We hope you have found this video interesting and informative, and if so, please give it a thumbs up and share it on social media. Please ensure that you have subscribed to our channel and press the bell sign so that you are notified of any future videos. Also, kindly visit our website at illuminatisilver.com, and if you haven't already done so, please subscribe either as a free or paying member for regular email updates and offers. Disclaimer: Illuminati Silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.